So I've just entered a brand new year and I've just posted a big update on my portfolio, and I want to do a second part to that and talk about my investing strategy for the next year forward. Now, I want to be really open and candid today and talk about all of the things that I've had going on and give you some of my honest thoughts. And I think sharing this transparency and being open and honest is a great way to go because it gives you guys a real insight into what I'm thinking, and it shows that we're not all perfect. Because I think on the surface, sometimes you can see my portfolio and think I've got it all figured out, but the truth is not everybody has, and life changes and your strategy and which account you focus on can change along the way. So hopefully by me sharing this with you, it will show you some of the problems I've hit and some of the things you might also hit in the future too. Okay, so there's a lot to unpack, so let's get straight into it. Now, first, we've got my Trading 212 account. This is my general investment account. Now, to be completely honest, this account is mostly made up of free shares I got from Trading 212 when I was promoting the platform. Now, they gave free shares instead of a fixed fee, so I ended up with a load of free shares on my account. And to be honest, the shares that I got were actually pretty good in big companies, things like Tesla, Microsoft, Apple, etc. Now, there are a few in there that I don't know that I am in the process of tidying up. When you compare that to the likes of Freetrade, where I also used to get free shares, they used to be all over the place and you didn't have any idea what most of the companies were. So I thought, well, why not keep those free shares, as I was planning to build a general investment account anyway, and let's see how they grow. And they've done really well so far. So I thought I might as well keep the account and build a general investment account, as that was actually part of my original strategy. Now, I mentioned this years back, but let me just recap what I was originally planning to do. So a few years ago, you could actually make £12,000 per year from a general investment account and take that tax free. Now, it's not quite as efficient as an ISA, of course, but if you'd filled an ISA, that's another good option. So my plan was always to fill the ISA and then put as much as I could into a general investment account. And then my goal was going to be build it up to say 100k, just above that, try and make 5 or 10% per year and take that £12,000 and either funnel it into my ISA so I didn't have to find the income every year to fill an ISA, or take it personally as income. And that actually was huge at the time, because if you think about it, if you could take so much tax free and then you could have another £12,000 on top of that, it provided a really good extra source of income. So my goal long term was always to build up this account to around £100,000 to £150,000 and take that income out. But of course that has been slashed recently and it's now down to £3,000, which isn't all that good. But still, you could have roughly around £60,000 in a general investment account, pull out 5% per year, and you could hit that £3,000 allowance. Now, it's only £3,000, but £3,000 is still pretty decent to have. Of course, you have got a slightly complicated process and you have to sell them and realize the gains and report the tax, but it's still probably worth keeping. So we pop some of the biggest returns on screen here. I've had things like Rolls-Royce, that's up 200%, Nvidia up 100%, things like Google's up 91%, and these are huge numbers that look so impressive on my account. Now, I have to admit, I am quite a vain investor, that when I've got them nice numbers, you don't really want to sell them and lose that progress. Now, in an ideal world, it would also be quite nice if I could just quietly shuffle them over into a nicer account and keep those positions. But because of the UK tax rules, you're not able to do that. They want you to sell, realize the gains and pay the tax that you due, and then rebuy them within your ISA. Now, I don't really mind doing that and I'm not completely against it, but I'm also quite vain and I really like seeing those numbers. And this is part of the problem that I've actually had before. When I've moved from one ISA to another, I've completely lost my gains and people are like, oh God, you've only made 1%. But the truth is, I've just moved platform and I've lost that progress. Now, this is actually part of the problem I'm trying to solve with an app I'm building, which I will mention a bit more later on. But the idea would be that you can move from one platform to another and still keep that historical data, which I think is huge. The other really interesting thing with this account, and what I've been thinking about more generally recently, is I'm actually able to take more risk now, which sounds pretty crazy to say out loud. But the position I'm in now is if I was to keep investing as I am, I will hit around 3.4 million by the time I was to retire. And if I carried on till I was 68, it would be worth even more, which, let's be honest, it's way too much money and it's not what I need. And my plan isn't just to be paying a 40% tax rate in my later life. Now, there's actually 2 points on this. So the first is that I actually kind of miss buying some individual stocks. Now, of course, I've got this free portfolio here, but I still also would be stupid to say I'm so into investing, but I hate buying individual companies. I think it's kind of a catch-22. Now, the broad general advice I give to everybody is the vast majority of your investments should be in index funds, and that is what will build you long-term wealth. But at the same time, I also enjoy buying some individual stocks and seeing how they perform, keeping up to date with the news and seeing what's going on. Now, that is a much riskier style of investment that I don't recommend people do, but at the same time, I kind of think, well, I'd like to have a bit more fun with a certain part of my portfolio, be that 5 to 10% maybe, and still keep the 90% in index funds. The problem I have with that, of course, is it does kind of go against what I'm trying to teach, and I like to practice what I preach, but I still think if I was to keep 90% of it in safe, solid investments so I hit my retirement goal, I could have a little bit more fun. I mean, you could argue I'm still doing that anyway, but of course this account is so small in comparison to my others. Now the second point is, of course, this year we have got this launch of the crypto ETPs. Now, I never really bothered with crypto. I did some small projects in the past, which some worked and some didn't. And the whole time I kind of thought to myself, well, I should have just bought Bitcoin or Ethereum the whole time and just held onto it. And I think there is an element there of FOMO and thinking, oh, why didn't I just do this? Why didn't I just do that? And I do think now with these new crypto exchange traded products, it gives an avenue where I could hold some of that within an ISA or a SIP. Now, there's a couple of problems there, and the launch has been a mess and super confusing. So you can't actually hold them within an ISA. Apparently, after April 2026, it may move into an innovative finance ISA, but that actually hasn't been confirmed. So you may still be able to hold them within an ISA, we're not sure yet. But the more interesting part of that is you can actually still hold them within a SIP. So that rule wouldn't change. So you could buy it within a SIP and hold it within there. Now, I actually sold the remainder of my cryptocurrency, but I could decide to hold like a small satellite position. It wouldn't be a huge percent, maybe 1% to 2% of my portfolio within something like that. And that would mean that I still managed to capture some of the action with Bitcoin and Ethereum without taking huge risks. Of course, Bitcoin and Ethereum is really speculative, but there is only a limited supply, and as people buy it and it goes more mainstream, then it's only going to go really up in price. Now, I will say it's high risk and I wouldn't recommend it to everybody, and I'm not telling you to run off and buy crypto, but it's interesting to think I could consider adding some of that into my portfolio now. Now, if you're thinking, God, Chris, you're crazy, let's talk about the rest of my portfolio, which is all based on the FTSE All World, which is a really global, broad, diversified index. Now, first onto my lifetime ISA. Now, this is actually a really funny account, and I actually messed up in my last video. Well, I didn't mess up, but it wasn't super clear when I talked about how much I'd contributed for the year. So it looked like I added £7,000 to my lifetime ISA, but it was actually a running total. So I got £6,000 in my stocks and shares ISA, and I put £1,000 into the lifetime ISA too, which is where this £7,000 figure came from. This is actually quite strange because I actually max this every single year, and my direct debit actually got cancelled without me realising. It's why I've only put £1,000 into it. Now, my lifetime ISA is with Hargreaves Lansdown, which is a bit of a pain in the butt platform, to be completely honest with you. And I don't think there's really good platforms for the lifetime ISA anyway. It's pretty much Hargreaves Lansdown, or you've got AJ Bell, who've also got Doddle. Now, AJ Bell and Doddle are slightly more expensive than HL, but on HL, you have to set up regular investing to get it cheap. And then the leftover and the bonus, you have to manually invest yourself. So I put most of it into the Vesco All World Fund, and then I put the remainder into a HSBC one, which is actually a mutual fund, but it does pretty much exactly the same thing, but the fees are slightly higher on that one. Honestly, I don't think there's much between any of the lifetime ISA platforms overall. Now, this is a really weird one because actually it's not really the most efficient thing for me to do, paying into a lifetime ISA. Now, it actually was a better account when as a basic rate taxpayer because putting that income in was around 17% better off than using another account. Now, the interesting thing about this, and the way I kind of have come to think about it lately, is, well, you don't have to be a basic rate taxpayer as per se. Now, of course, any higher rate income is clearly better in a self-invested personal pension or a SIP, but actually you have the rest of your income in the basic rate band. So you can think about what portion of your income are you paying into what account. So, for example, if I was to pay that basic rate income into the lifetime ISA, then it is kind of better. But the question is, with the SIP, I'll have enough when I get to 60 anyway. Do I really need to be focusing on the lifetime ISA? Now, I've always been at the mindset that, well, that £1,000 free bonus is too hard to say no to. And by the time I keep compounding on that, it's going to be worth about £100,000 extra in my pocket at age 60. So realistically, it's probably still worth me doing, but it has been giving me some thoughts lately. For example, am I willing to forego that bonus to get more into my ISA that I can access early enough too? But the truth is, I'll probably have enough in my ISA anyway. But we do have to think about timelines of when each account will come into play. My goal isn't just to have a ton of money at age 60. I want to balance it so I've got enough along the way too. And I need enough from age, say, 50 or 55, whenever I decided to retire, that I'd have the income generated for me. Now, before we get into my two bigger accounts, I know I'm going to get a ton of questions on this video because I get it all the time as to, is now a good time to invest? Should I be investing? What do you think I should do? Well, The truth is, I think it's always a good time to invest because my general opinion is, well, get the money in there that you've got, but try and consistently invest after that too. So what I mean by that is if the market goes down, it actually works in your favor because you're able to buy those units at a cheaper price, ready for the future. So for me, it's actually more beneficial for me for the stock market to crash and then come back up so I can buy more. And that's the way you really have to think about investing. You need to be thinking about, well, I can just buy more at a cheaper price all the time, ready for the future. So although my portfolio going down 10% might put me down £40,000 at the moment, which is absolutely terrifying, which is a problem that's only going to grow worse and worse, it gives me the opportunity to buy more and then ride the wave back upwards too. So the simple answer is it's always a good time to invest. Just I would say try and be consistent. It's only really a bad time to invest and you only need to think more about timing the market and what you can do with your portfolio if you plan to lump some money in and then you don't plan to continue to add more, because you should always really try to continue to add more to take advantage of all of those dips. Okay, so on to my biggest single account, which is my ISA. This is the one I've got over Invest Engine, and this is currently worth around £182,000. Now, this is the account that I started with, and it is my most beloved account. And I did have that idea when I first started of wanting to become an ISA millionaire before I shifted out into these different accounts. The really good thing about this is it does provide me with more flexibility and options down the line. So I'm currently adding around £500 a month to this account, which isn't a huge amount of money considering my goal was always to hit that £20,000 allowance. But of course, now that's also split between the lifetime ISA too. I'd really like to get this back up to maximising it so I could put £14,000 into here rather than the £6,000 I'm currently doing, but it depends what my use for that cash is in the tax year really. So my goal for this is really two things. One is to generate some additional income from my early retirement age. So at the point I decide to retire, I want to generate some income, which I'll talk about later, but I also want to generate a portion of tax-free income too. So this is the purpose the ISA will serve. But on top of that, I also want it to take income in retirement tax-free. So say I want to go on a holiday or do the bathroom, or I just want some general extra income and I don't want to pay tax on it, which, let's face it, when we get to retirement, the last thing we'll want to do is be paying tax. It'll be nice to have that option available. This will probably, realistically, in the future, be the account I drain first, which will be a sad day to say the least, but it's really important to build this account up. This is the account where I use my two-fund strategy, so I've got my Developed World ETF, which makes up around 90% of the portfolio, and I've got the Emerging Markets, which makes up 10%. So overall, for those two, my fee is around 0.13%. Now, I'm not going to sell those investments. I plan to keep those in my ISA for the foreseeable future. Now, sticking on Invest Engine, moving on to my pension, I've got my one on Invest Engine, which is currently worth £65,000, which is in the same two funds, the Vanguard Developed World and the Emerging Markets. And I've also got my one on Vanguard, which is worth £135,000. And that's just invested in the one fund, which is a Vanguard Developed World Fund. Now, I've got a bit of a confession to make here when it comes to my pensions, in the fact that I haven't actually invested any money into my pensions for quite some time. Before the end of the last tax year, I actually put in £42,000 in one big lump sum. Now, I'll have to hold my hands up and say that I am quite an opportunistic investor, and I saw all the things going on with the tariffs and saw how much the market crashed, and I decided to jump in, which of course did work in my favour. I actually chose to split the investments because I thought, well, £42,000 is a lot to put in one time. But the truth is, when I did that, the money I didn't invest actually did worse. So I actually lost out on a couple £1,000s by doing that, so be aware. The truth is, statistically, lump sum investing always works, but the truth is in the past, I've done better from averaging into the market. But what I like to do is always have some cash on hand so I can invest more if things look bad. But the truth is, you should really just get the money in there and never worry about it. But why have I actually stopped? And this is a big question. This is a really interesting point that I think is something that occurs later down your investing journey. And it's not something I've had to deal with before, but it's been this niggling feeling that I've had in the back of my head for some time. So I'm actually getting to the point where I could hit the maximum you can take from the tax-free lump sum. So you can currently take £268,000 tax-free out of your pension when you choose to take it, and the rest is classed as taxable income. Now, this is an incredibly nice problem to have, but it's not very efficient if you go over that amount. So what will happen is if you go over that, you can end up with the vast majority of your income coming from your pension being in the higher rate, which is not really what I plan to do. I'd rather have my income more efficient at that stage, and I don't really think that's how much I will need in retirement. I think basic level income will be completely fine. So it's really interesting when you look at this, and this is also something I'm planning to try and sell for the app, which will come later. But essentially, when you think about it, if I can take that money out tax-free lump sum, then it depends how much I want left in the account. So let's say I wanted £50,000 in the year, which is probably more than I would need. So if we take that basic number and times it by 25, that gets us to 1.25 million, which is an incredible number to hit, especially after you've taken that tax-free lump sum. Now that could be the limit of where I want to go. Now that number actually takes into account that you wouldn't get the state pension. Now I'm hoping, of course, I will get the state pension. I think there has always been the fear that the state pension wouldn't exist, and other generations have also worried about this too. So I think it probably will be there, but it's quite good to make your plans around not having it so you don't rely on it. So that's also a consideration I need to take into account, because there are factors that come in later, things like reduced spending at 75. Of course, if you get the state pension, you're not going to need as much in a pension, so don't panic. Now, the problem is with my pension, if I kept investing as I am, putting say £1,000 in a month till I hit 58, which will probably be the age that I'm actually able to access a pension, I would have at current around 1.45 million in there. So it's not far off that number. So I don't think I'm quite at the stage where I don't want to put money into my pension, but it's starting to become a niggling feeling in the back of my head. Now, the other consideration is there that I'm also not taking into account inflation. So for example, £1 million today in 21 years time, when I want to take it, will actually be the equivalent of 1.71 million, which is incredible to say out loud. So probably I would be completely fine continuing to add to my pension, but it has given me a moment to kind of pause and really think about what I want to do. Now, the other options I've got available are to potentially front load my pension, so I could put more money in now and then stop investing later as heavily. Because let's be honest, I don't actually know what the future holds. For the vast majority of my life, I haven't even been in the higher rate income. So while I do have that available, it could be worth just really focusing on the pension, but you don't know what the future holds. I may not be able to contribute in the same way in the future. We'll have to see. And actually, the truth is, if I was to put more money in now, that means I won't have to add as much overall, because the earlier you get the money in, the longer compounding has to work its magic, and you don't have to be so reliant on your contributions. So one strategy I could do is, let's say I was going to retire at 50, because part of the problem becomes is, say you did want to retire early and you still want to get that pension, you're still going to have to make those contributions so that you hit your goal. So it could be a case that I contribute up to say 50 and then work on the basis that it's going to be completely paused until 58 or maybe 68 whenever I decided to take it. The downside of that though is if I do have higher income in the future years, then it's also not the most tax efficient use of that money, because it would be taxable if it's not going into the pension. And this next section kind of leads into this. So I want to talk about business in general and what I've been planning to do. So I've actually transitioned into a business now. So what that means is I'm not like some fancy big business, but the truth is I've now got more control over how I process my income. And the really beneficial thing about this is it allows you to control how much income you get and where. So when I've been self-employed, you essentially just have to take the income and you're like, oh geez, the income's coming in, I've got to pay tax on this, I've got no control. But as being a company, I'm able to say, actually I have this much income there, I can put this as an expense, I can invest this, and this is what I can do. Now, the problem is when you get to profits, it's like, well, what do I do with the profits? Because if you keep the money inside the company, you have to pay corporation tax. Whereas if I was to put all of that money into a pension, it really reduces your corporation tax bill. Now, I know a lot of people are going to say, oh, you should go and speak to an accountant. And I actually do have an accountant for my other business, but I don't have one for this one as of yet. And to be honest, accountants can help, but the truth is all they can really say to you in the end is, well, what is your goal and what do you want to do with your money? And that's kind of what this all ties into, because it's been a really strange position, to be honest with you. Like, I've had a web design business and that was always a business on paper. But the truth is, it wasn't really a business. It was just kind of like a self-employed person wrapped inside of a business container. So it was always like you got the income and you just took it out and that was it, paid your tax, job done. Now I'm in a position where I'm actually thinking, well, can I actually build a business? Should I be reinvesting the profits into something else? And I've actually got people working for me now. So I've got a video editor pretty much working full time. I really need a second video editor. I've got my partner helping with short form content. I've got an app developer that's working on my app. And I've also got the person working from my web development company that works for me too. So the pressure actually does mount. And I think it's really interesting when you think about that, because you think, well, you know, I've got to make sure I've got the income to make sure these people have got their jobs and they've got enough income coming in. And it's actually really surprising that when you see people making videos on here, and I had this kind of illusion before I started, it was really easy. You stick on a camera, record, up the video goes, and it's nothing like that at all. You know, it takes like a week to make a video, and it's such a time and investment to do these things. So I think it's really interesting to think about. Now I've got this potential to potentially grow a business and what I want to invest in and what I'm planning to do. So I've been doing a few things around that. So the first thing I've been doing is I am investing in this app. So I've spent quite a bit of money so far on this app. To date, I've probably spent around £20,000 so far, and I haven't even got a prototype ready to show you guys. So I'm hoping within the next few months, I'll have a prototype, we'll have some testers on board, and that will be super interesting. Now, I've got no idea whether this app will actually work, but it's something I wanted to build for myself, and I would really like you guys to have the opportunity too. I will go into all of this in more detail, but the goal is essentially to have something where you can track all of your investment portfolios in one place. And I think that's really exciting. It's something I've not been able to do with all these accounts for such some time. I used to make little Photoshop graphics. I'll put one on screen here to show you. And these were really popular, and everybody used to ask me, you know, what app are you using to track your portfolio? So I'm actually essentially deciding to build that, and I'm going to bolt on some really cool features too, things like tracking your progress, how you're getting on for retirement, have you got enough, which accounts you need to focus on, any news specific to your portfolio, and there's so much cool stuff you can do with that data. And of course, keeping historical data when you move from one platform to another will be huge to track it all in one place. So yeah, that's really exciting, but it's a big commitment, and I'm not going down the route of wanting to raise a ton of money. I don't want to do that. I just want to bootstrap it, pay for it all myself, and try and grow it organically. I don't know whether it'll work, and it could be a complete fail, but it's something that will probably be launching this year, and I'm really excited and nervous at the same time. Now, equally, I've also been thinking about, can I invest cash? So you can do things like invest through a company, and you can build assets, which is actually really interesting, and it could be a route to go down in the future. So I'd actually invest my business cash now. I've got some in a money market fund, which gets me some kind of return, and I keep that money for tax. And then also I'm planning to invest in the stock market just like I would anything else. So that'll be in the same global index funds, but with my business cash. Now, that's a really interesting concept, and it will generate a return. And I did go down the route of thinking, well, you know, if you can build a business with assets, I think that's actually really admirable. So if you could generate an income purely from the assets in your business, be that rental properties, investments, whatever it is, there is a huge benefit to having that. And the other upside of that is, well, if I do keep cash in the business, if things go awfully wrong, I mean, I am completely at the mercy of the YouTube algorithm. If that decided to go down and I'm suddenly not making an income and this all goes one day, which at least then I've got some kind of safety net so I can still pay myself an income. Now, the other big benefit of that is also it'd be amazing if I could pay an income from the company from those assets. So when I come to retire early, the goal originally would be, okay, well, let's use the ISA. But the truth is all of that ISA income is tax free. So ideally you want £12,000 at the moment generated from somewhere, which is your personal allowance. So if I could generate a personal allowance for me and my partner from the company, that would be the dream scenario. I mean, even going beyond that, in a dream world, if you could generate a £50,000 income for you and your partner from a business without needing to work, well, you don't even really need a retirement pot if you've got that income being generated. So that's another thought process going on in my mind. And I know people do things like buying properties within companies. I think property development has got really, really hard now. And the truth is, I don't know all that much about properties and property development of buying them and renting them out. Of course, I could do some of the work myself. Like anything, it all comes down to time, and do I want that stress and pressure? The truth is, I'd probably be better off just investing the money and focusing on doing this. Now, the other really interesting thing I've been doing is this house. So it's coming up 2 years I've been in this house now, believe it or not, and I'm still in the process of renovating it. I kind of bought a house that was a good deal, but it probably needed about £100,000 realistically of work needed doing on it. I moved in and I thought, well, we'll just paint it. But the truth is, I've put in a new heating system. I've knocked down walls. Now I'm looking at changing the kitchen at the end of the month, and I'm looking at changing all of the windows. I mean, the costs just add up and up and up. So I'm actually going to probably separate that into another video. I've been a bit hesitant, and it's kind of in two ways. So the truth is, at one point, I thought, well, what am I going to show? So I really want to wait till I've actually got it to a point where I've made a bit of a transformation, so you don't think, well, Chris, you bought a project, but it looks pretty much the same after 2 years. What the hell have you been doing all this time? So I want to get it to a point where it's actually quite good. So I might do a complete breakdown then of all my costs, what I've done so far, what my plans are, because I think it's really interesting to be transparent with that. Now, the other slight hesitation with it, being completely honest with you, is I've had a couple of scenarios which have been a bit awkward and a bit maybe invading your personal privacy a bit. And don't get me wrong, I'm as open as the next guy. If anyone saw me in the street, I would chat and talk to them. I share all of my finances online, which most people think you're absolutely crazy for doing that. But I think it reaches a point where you think, well, do I really want to get to the stage where someone finds my address and they turn up at my house, either asking for finance advice or even worse? Because let's be honest, people read things online and they think, oh my God, this guy's rich. I don't want someone turning up and thinking, oh, he's got £400,000 under his mattress, when actually it's in my pension account and you're not going to get anything from my house. Let's be honest. So yeah, and then thinking into the future, if I do have kids in the next couple of years, do I really want to be worrying about somebody turning up at my house with them kind of intentions? I don't know. Obviously, I could try and hide that stuff as much as possible, but you could do research and find what property it was, what I bought, etc. So yeah, that has been a bit of a hesitation in the back of my mind, just to be completely honest with you. And the next thing that's been on my mind, which I think has been a bit of an ongoing dilemma for me for the last few years, is do I want my entire life to be about saving for retirement? And I think in some ways it's great to have the pension and I want that security there. And I do want to retire early. I really enjoy what I do. I have flexibility. Okay, I want to travel more of the world and maybe I could adapt my lifestyle to do that because, I was talking to my partner the other day and when I start looking at, how many years I've got left, which is actually shorter than I think, all the places I want to go and things I want to do. And I was saying realistically, I'm never going to get to these places because I just haven't got enough years to do it. Going on one holiday a year, I'm never going to achieve the level of travel that I actually do want to do. And travel's really important to me. I want to see more of the world. I want to do things, experience things. So whether my lifestyle would shift more into that, or I do actually like the idea of having a place abroad. So for 6 months of the year, when the weather's horrendous like this and we've got dark nights, horrible weather, it'd be amazing to go, okay, I'm going to go for a couple months and go to my place abroad and work from there. That's also something that's always kind of been a goal in the back of my head, which I've never really thought could be a reality. And I don't know whether I could afford it, being honest with you, but maybe it's something that I could work towards and maybe rent it out when I wasn't there too. That's also something I could think about buying within a company, but it's a bit more complicated and I've not got far down that line. But also I've had a couple of situations recently where I feel like every other month there's another close family member or someone that's just died early. And I think that's really sad. And I don't want to be in the position where, the ones I know recently, for example, have worked all their life, they've got to early retirement, they've just started traveling the world, and now partners have died overnight, and then your plans are just put on hold, and all those dreams and aspirations that you had of traveling the world, doing all these things in retirement have just come to a halt. And the truth is, we never really know when that could happen. And I think that's what's so difficult is, tomorrow it could be, that's it, game over, you've got 12 months, that's it. And I think we really need to think like that. We need to live more for today and not just live for the future. But that's a balance because you need the future, but you also want to live for today. And the truth is, I also know, and it was really interesting, I was watching a podcast recently which really resonated with me, and it said, you're not the same as life goes on. Me at 36 now, when I was 26, I was so much fitter, more healthier, things didn't ache as much, and that problem's only going to get worse as time goes on. Traveling in my 60s or 70s is just not going to be the same as traveling today. So I want to find a bit more balance of that in my life. My plan isn't just to work and save for the final quarter of my life, which is sad to say, but it's also important to say too. And I also want to say there's this kind of illusion, especially when you see people saving and kind of investing on the level I do, you don't live your life. And the truth is I really do. I go on holiday 3 to 4 times a year. I spend money on the house. I do buy things. I just don't waste money on things day to day, but I do buy probably more than most people would. So there's always this comment that, I'm this kind of recluse, and it's not the case whatsoever. I actually saw this amazing comment the other day that said, I sit in my room and sniff my own neon farts, which I was like, oh my God. So yeah, that's a completely honest, maybe too honest breakdown of all of my accounts, what I've got going on at the moment and where I'm thinking. These are still things that are a work in progress, and I think my decisions will change, maybe my priorities will change as life goes on. When kids come into the picture, I'm kind of fortunate, depending on which way you look at it, I don't have all of that cost, which other people do at the moment. That could change into the future too. But hopefully by sharing these with you, you probably see that I've got a lot of the same dilemmas that you might have too. Let me know if you've got any questions, as I'm honestly such an open book when it comes to all of this stuff. I'll keep you updated on all of my plans. And if you want to join the waitlist for the app for when it comes out, because I think it's going to be so exciting, I'll pop a link in the description for you down below. Thanks for watching, and I'll catch you guys in the next one.